Good morning from our global headquarters in New York. I'm Menace Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set your agenda.
A major escalation. Israeli troops move into Lebanon, launching targeted ground raids aimed at Hezbollah. A message to the market: we are not in a hurry. Fed Chair Powell reiterates data dependence. Up next, JOLTS and PMIs. And an all-out strike. Dock workers walk out of every major port along the U.S. East and Gulf coasts. Good morning, Manus.
Danny, good morning. It was the Powell Gazette. We're not in a hurry to cut rates. I'm not in a hurry, and if everything else remains equal, 250 basis points cuts is what's coming. This is state of play on the equity markets. It was the bond market that woke up more than the equity markets. By the way, we start the fourth quarter a little bit on the back foot, down by an eighth of 1%, but we added $2.5 trillion in equity value and wealth in the third quarter. Roll it over, have a look at the bond market, because this is where, as Larry Fink says, this bond market is crazy on the forwards. It's pricing in way too much cuts. We've just sat down with Larry Fink. More on that conversation a little bit later. Yields drop ever so slightly, and this is where the field of dreams really and rate cuts came to be, I suppose, rephrased yesterday by Jay Powell. You've had 5 months of a rally, the longest run up in terms of, down in yield and rally in bonds that you've seen since 2010. But a message from Larry Fink and the rest of the market: you're all just a little bit crazy on your forward curves.
Well, man, it's some good news for the ECB. Eurozone CPI breaking. First time it is sub 2% since 2021. Consumer prices rising 1.8% year over year. That is in line with the estimate. Core also in line with the estimate, 2.7%. And month over month, actually lower than expected. Month over month, CPI falls 0.1%. The estimate had been for it to be flat. This will reinvigorate those who think rate cuts are to come in October. Manus, we heard from Christine Lagarde yesterday saying that she has more confidence in inflation, and that bodes well for October, explicitly mentioning the month at the moment, 91% odds that they cut in the month.
And that was the magic words that came from Lagarde yesterday. They're going to take this drop in inflation into account in our next monetary policy meeting. The swaps went pretty aggressively, going from an 82% probability of a rate cut in October to 92%. So this is the clear trajectory for the Eurozone. Just look at some of the numbers. 1.8% in Germany, 0.8% in Italy. So this is disinflation writ large.
Yeah, and just to walk you through what the bond market doing, German 10-year yields lower by about 6 basis points, but we're seeing that across sovereign bonds. There is a rally this morning, maybe somewhat tempered by Powell yesterday, but at least in Europe, they have the green light.
Indeed. Well, geopolitics is front and center for us. Israel says it has begun what it describes as a targeted set of ground raids in southern Lebanon, defying the international calls for restraint. The military has been striking targets in villages close to the border that pose what it calls an immediate threat to communities in the north of Israel. Dan Williams is reporting for us from Jerusalem. Dan, look, what does Israel hope to achieve from this, as we understand, a targeted set of strikes to try and degrade Hezbollah's arsenal?
Hi, good morning. I'm actually not in Jerusalem, on my way up to the Lebanese border now, hence the unusual setting of this interview. What Israel hopes to achieve is the completion of the operation it launched exactly 2 weeks ago called Operation Northern Arrows. This operation is meant finally to dislodge Hezbollah from the border areas, to degrade its capabilities, and to decapitate its leadership. The last two aims we saw over the last 2 weeks. The first we're seeing now, because the declared war aim that Israel added a few weeks ago to this Gaza war that erupted almost a year ago was the return of some 60,000 residents of northern Israel safely to their homes. Those are people who left under Hezbollah fire almost a year ago. And to do that, it says it needs to physically go into some areas of the border on the Lebanese side and physically dislodge Hezbollah fighters, Hezbollah shooting positions, and to expose and destroy Hezbollah bunkers and tunnels.
Dan, Israel, the language they used, they said that they were conducting limited, localized, and targeted raids. What is the risk that it expands something beyond that?
Well, history has taught us that these things may start small, but a raid like this into another country can eventually ossify into a long-term open-ended occupation. Now, Israel has said it has no intention of doing that. It is aware of the historical precedent, and it appears that behind the scenes, the Israelis are already in touch with perhaps the Lebanese military, with the United Nations, with the United States and France, with a view to, once Hezbollah is dislodged, having some sort of workable alternative there. Perhaps the Lebanese military, perhaps with some sort of Israeli involvement and oversight. I don't think there's any intention by Israel to stay long term. Obviously, tactically, operationally, the risk is a spike in Israeli casualties. For a time now, Israel has suffered relatively fewer casualties in Gaza as it's overrun the Palestinian enclave. Now it's entering what would be, in a sense, virgin territory for its ground troops. Hezbollah has said it would welcome the opportunity to fight Israeli troops on the ground. Presumably it's set up ambushes. Presumably it's ready. It has the defender's advantage. So I think the Israelis are bracing for an escalation on their side of casualties from this. Certainly there will be Lebanese casualties as well. The question is, who remains of Lebanese civilians on the other side, given that they've been long warned by Israel, and indeed the area has seen months and months of Israeli counterstrikes that have driven away many civilians.
Dan, thank you so much for your reporting, and we are wishing you a safe journey there to the Lebanese border. That is Bloomberg's Dan Williams. Manis, let's get to some of the other top stories that are trending on the terminal this morning. CVS is conducting a strategic review of options that even includes a possible breakup. That's what sources tell us. The company has cut its 2024 earnings forecast for the past 3 quarters. It's had challenges in its drug store chains and health insurance arms. The stock now down over 20% from its peak this year.
Pfizer has raised over $3 billion from the sale of some of its stake in Haleon. The pharma giant has been selling down its stake in the UK-based maker of Panadol. Haleon was originally formed as a combination of GSK and Pfizer's consumer health units. Pfizer began trimming the stake in March. GSK sold its final shares in the company in May.
And Michael Dell, the founder and CEO of Dell, sold 10 million shares of his company's stock last Thursday. That meant he raised over $1 billion. He sold another 10 million shares in the company, worth around the same amount, earlier in the month. Dell stock has jumped over 50% this year, along with a slew of tech names benefiting from what else? AI.
Coming up on the show, we'll count you down to the data, coming out a little bit later today with Emma Wall of Hargreaves Lansdown.
And later in the hour, with earnings growth passing expectations, Kathryn Rooney Vera of StoneX discusses why she thinks the S&P is going to hit 58,000 by the end of the year. That's all to come on your brief. Stay with us.
This is not a committee that feels like it's in a hurry to cut rates quickly. It's a committee that wants to be guided. Ultimately, we will be guided by the incoming data. If the economy performs as expected, then that would mean 2 more cuts this year.
That was Fed Chair Powell speaking yesterday at the National Association for Business Economics, making clear that his baseline is 25 and 25 again for the rest of the year. Joining us now is Emma Wall, Head of Investment Analysis and Research at Hargreaves Lansdown. Emma, great to speak with you this morning. So there you heard from the man himself, 50 basis points, assuming everything goes as planned. The market pulled back from that, but we're still pricing in some 65 basis points of cuts. Is this a market that still just has too big of a bias to Fed cuts?
I don't think so. I mean, it has been 2 stories that have dominated most market returns, not just in the US, but I'd say globally this year. And it's tech stocks, we can come on to those, and it's central bank policy. And what we're saying to clients is, look, you might be unsure as to whether there are those 22 lots of 25, as Powell says. Don't forget it's a democratic process, so what he says doesn't mean it necessarily goes. Or it could be another 50 if the economic data comes in much weaker than expected. But ultimately, this is a market where bond yields are coming down. They've already started to come down. And so we see a great opportunity here for total returns. And we're encouraging clients on both sides of the pond, actually. There are opportunities in fixed income. Lock in some great income now if that's what you need, or go on an aggregate approach, buy an index, look for a great active manager, and ride this story down, because yields are coming down, which means total returns are coming up.
I like what you put it as, Emma. Good morning. Keep it simple. Buy bonds. Larry Fink has just finished his conversation with Francine. He said this market is crazy to assume we're going to get 190 basis points of cuts by the end of next year. What would that destination look like for you with a long bond call like that?
I agree with Larry, and I also think that we've got to be, a bit mindful of where we were this time last year. Don't forget, last December, we were so bullish on bonds that we were pricing in something like 6 rate cuts for 2024, which, of course, have not materialised. However, at the risk of repeating myself, we do think we are at the beginning of quite a substantial bond rally. We also think this is why it's a great opportunity to go with active management, because they can really play the volatility, because we are expecting this not to be linear. We are expecting there to be volatility in this market. We've already seen it considerable amount of volatility over the last couple of months. Every time there's a piece of jobs data, non-farm payrolls, every time one of the voting members comes out and says something slightly hawkish, then you see that volatility in the market. But we think the trajectory as bond yields are coming down, therefore total returns are going up with volatility along the way. So be prepared to back a manager who can play that volatility for you.
Emma, also in your research, you write something that would have been very controversial, maybe even just 2 weeks ago. Very simple, 3 words: we like China. How much of China is predicated on continued stimulus from the PBOC, from policymakers in the region, or regardless, have they done enough that you can say, hey, I can buy this region?
Yeah, so we made a call at the beginning of the year that actually the 3 areas where we saw significant value were UK stocks, fixed income and China. And those have taken a little longer to play out than we expected. But, China was a call at the beginning of the year, which we made, to be honest, purely on valuation basis. We weren't making a call then about necessarily the macroeconomic picture. We do think the stimulus this week has been obviously extremely positive for the market. And we think there is continued market rally to come. What we would caveat, though, is we expect volatility along the way. And we'd also say that there's more significant work needs to be done, particularly with the way that the government considers its involvement in certain sectors and certain stocks, in particularly the tech sector. We also think that the US election is going to be really pivotal for China. But on a pure valuation basis, even on the near 30% rally that we've had since February, we do think that China equities continue to be quite compelling on a long-term view if you can stomach vol.
Yep, it's all a question of whether you can stomach the volatility. And we've had some volatility in US, the market between Mag 7 and the rest of the market. You're very squarely in the camp of it's the other 493 that you want to buy. I just wonder what you make. The earnings in the Mag 7 are still in the high teens. Does that mean for you still hold Mag 7 but reach for breadth?
Absolutely. We're not saying take a bet against the Mag 7. We're saying this is a great opportunity to take some gains, which, if you've been in this market for a couple of years, have been significant. We're also not saying that necessarily the valuations of these stocks are wrong. But actually, if you play that through, if you say that the valuations currently in the market for the Mag 7 are correct, what you're saying is that the AI revolution truly is that. It's a revolution, which means it will benefit more than just the Mag 7. I've parroted this term to my team already, but the invention of the wheel didn't just benefit cars. It was truly transformative. So therefore, if AI delivers on its promises, actually the beneficiaries will be far more widespread. And then you flip that on looking at a valuation basis, Russell and the 493, you've got some really high quality companies here that have just been out of favor. So it's a mix of maybe AI is right, maybe it is as revolutionary as the Mag 7 are leading us to believe, in which case there'll be a benefit. But on a valuation basis also, there are just some really interesting areas of the market where you could take some gains and redeploy.
Well, one sector that has certainly benefited from AI and just the fact that it's defensive is utilities, up 27% year to date. That outperforms the S&P 500. Emma, if we need to care about valuations, has that as an AI play gone too far already?
Well, I think there is some frothiness in the market. And also, I think as we have a normalized interest rate environment, you may see some of those coming off. And of course, as you get the updates from the companies, the expectation is so high that any misstep, even if there are positive numbers, if they're not what the market expects, you will see some of the valuations come off. However, I don't even think, as I said, you have to make a call about these valuations being significantly outlandish. In order to follow through that on a medium to long-term basis, there are still opportunities in the wider market. Because as I said, if that AI revolution flows through, then the beneficiaries are wider than just that extremely small, not even Mag 7, Fab 4 stocks.
Yeah. Look, one theme that has come through over the past 7 days is the auto industry, whether it's here in the United States of America or indeed in Europe. But Stellantis yesterday warning, and the dealers here saying you're degrading our brands in the United States of America. How much of a warning flag is this current in the autos, global autos, and especially here in the US?
Yeah, I think actually this is one of the areas where the upcoming election is incredibly important. We've seen a lot of issues in Europe because of autos and because of the Chinese tariffs. And that tariff war that we saw at the beginning of the summer, where you see that tit for tat, has been really damaging. We saw some significant, drops in some of the European autos in June, July, as those tariffs started to come through. Now, this is a war that we need to be really careful. It plays back to the China story. If we enter into a tariff war between the US and China and Europe and China over autos, actually, there are no winners. So it's definitely something that we're keeping our eye on.
OK. Emma, thank you so much for being with us this morning. Quick jog across those markets. Emma Wall of Hargreaves, Lansdown. We'll have more on these markets and the port strike, which has just gone live across the eastern seaboard. It's Good Morning from New York. Time now for the front pages. This is what's making headlines around the world. We kick it off with the New York Times. Biden says he could ask Congress to pass aid for catastrophic Helene damage. The president said that he may need to call Congress in for a special session after it did not include additional disaster relief in its spending bill. And the storm has left over 100 dead and hundreds unaccounted for.
Next up in the Journal, Vance and Walz, they are set to take the debate stage. The two Midwest running mates are looking to boost their candidates' campaign for the presidency. It is the last scheduled debate before the election in just 5 weeks. They're going to be meeting in New York. That debate, Manus, will be hosted by CBS. OK, we're certainly counting down to that. What is it? Don't do any damage. I think that's the message. Just keep it on the tracks. OK, we're leading on Bloomberg with the strike. It's shutting down the U.S. coastal ports along with the Gulf ports. The threat is to the economy. The dock workers have walked out of every major port in the U.S. along that eastern seaboard. The affected ports have a combined capacity to handle as much as half of all U.S. trade volume. Let's get to our trade czar. It is Brendan Murray. Brendan, you say that this could unravel really quite quickly. The scale of this isn't just about wages, it's about automation, and we're looking at a potential cost to the economy of anywhere between $4.5 to $7.5 billion. How quickly does this pinch?
Yeah, I mean, look, we saw during the pandemic that a congested port in one part of the country can kind of ripple to others. But this is something we've not seen on a scale on which we've not seen in a long, long time. 36 ports between Maine and Texas, 45,000 workers walking the picket lines now. We've seen estimates anywhere from $1 billion a day to $5 billion a day. The costs are going to add up pretty quickly, and it's just a matter of time before consumers feel the pinch of both shortages of some goods and higher prices. The big question is, will the federal government step in and try to mediate some sort of solution? But at the moment, the two sides, the employers and the unions, seem pretty far apart. They traded barbs overnight, and it seems like it's going to take a lot of work to get them back to the negotiating table.
But I was going to say, what have we heard from them? What do we understand in terms of just how far apart they still are?
Well, the employer group, the Marine Alliance, said that they offered to increase the wage proposal to a 50% increase. That's over a 6-year contract. That is short of the 77% bump that the union wants. So the union rejected that overnight and the strike started at midnight.
Well, there's certainly some rich language on the board from the Brotherhood of Teamsters, isn't it, in terms of telling this administration to stay the heck, I'll paraphrase, stay the heck out of this fight. That's not the language they use. What is the possibility that Biden steps into this? There is an act, the 1947 Act, that he could use. What's the risk? What's the reward if he steps in to halt this strike?
Yeah, look, we're 5 weeks away from the election now, so the pressure will build on the Biden administration. The president said on Sunday that he doesn't believe in using the Taft-Hartley Act. He wants to see the collective bargaining process play out. Siding with unions is going to really help the Democrats, against Donald Trump. So it's a tight rope he's got to walk here, and really no-win situation. But the pressure is coming from businesses for the president to step in and do something to stop this strike sooner rather than later, because the longer it goes on, the problems just compound and they're harder to dig out of.
Yeah, the estimates for every day that there is a strike, something like 3 to 6 days to clear that backlog. Brendan, thank you so much. That is Bloomberg's trade czar, Brendan Murray. Okay, coming up, we're going to talk about the data. We have JOLTS and PMI on deck this morning. We're going to push ahead with Kathryn Rooney Vera of StoneX. That's coming up next. From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger alongside Manish Krani. Let's set your agenda.
A major escalation. Israeli troops move into Lebanon, launching targeted ground raids aimed at Hezbollah. A message to the market. We are not in a hurry. Fed Chair Powell reiterates data dependence modes. Up next, JOLTS and PMI. And an all-out strike. Dock workers walk out of every major port on the U.S. eastern seaboard and the Gulf Coast. Danny, good morning. We're not in a hurry. Did you get the message?
The markets kind of did. Yeah. We're not in a hurry. The baseline is 50 basis points of cuts. We have seen yields yesterday move higher. They moved down this morning just by about 3 basis points. We're pricing in something like 60 basis points of cuts, so still not to the 50 baseline of Powell. But man, what a quarter it has been. We're now 5 months of gains for Treasuries. That is the longest winning streak since 2010. We're now up 20% on the S&P 500 for the year. More than that, we're a little bit weaker this morning. We weakened slightly after Powell spoke. We rebounded. We're down again. Dollar is stronger this morning against most G10 currencies, notably against the euro, with the data of CPI coming in below 2%. And we're weaker versus the yen. The yen has had its strongest quarter since 2008, Manis. So that takes a breather today, but man, what a September it was, and welcome to October.
Welcome to October. The superlatives fly around, don't they? I mean, it's 5 months in a row for the bond market, longest stretch of gains since 2010, and the best start to stocks since 1997. But when it comes to this recalibration from Chair Powell yesterday, I wonder just to what extent has he managed to regrasp some of the narrative. He couldn't have been clearer, which is, look, unless anything changes quite dramatically, calm down. You're getting 2 cuts, 50 basis points. Stop betting for 75.
Yeah, and we're going to catch up with Mike McKean a little bit about this. But I thought one of the more interesting things he talked about was there's a tension with the labor market, which is cooling, and consumption and GDP data. He kind of had to talk around it because that data has been coming in strong. He essentially said, look, the labor market gives us more real-time data, and you can't look to GDP to essentially say, is there a recession? So it's very clear to Powell that one piece of data matters, and it's labor market data.
He did say that participation is high. He did also warn that jobs are not as plentiful as they were in 2019, which is almost doffing his cap to the fact that you are looking at quite a dramatic change in the unemployment rate, and that if that tips, he will tip his hat.
Duffing his cap?
To doff his cap.
I've never heard that before. Is that like a tip of the cap?
Doff your cap.
Okay, good. Phrase of the day, everybody.
Phrase of the day. Doff your cap.
So we have key economic data coming today. Traders are looking for clues on the outlook for interest rates for the rest of the year. Let's bring in Bloomberg's Michael McKee. Mike, can I just get your takeaway from Powell yesterday and your duff of the cap, I guess?
I would tip my hat to fewer rate cuts. At this point, the thing is this is going to go back and forth. Now, we don't have another Fed meeting until November 7th, and it's 2 days after the election, and there's so much in the news this morning. I mean, who knows where we're going to be, but we do get the JOLTS report today, and Jay Powell did cite that yesterday, noting that the labor market has loosened up some, but he noted there are still more jobs than available workers. 1.2% is the additional ratio for jobs to workers, and that's not expected to change today because economists have no idea really where JOLTS is going to come in, and they're betting that it's going to be exactly the same as it was in August, 7,673,000. So that's kind of a wild guess, I think, but we've had trouble with JOLTS lately. Then we get ISM, you're talking about GDP, we get ISM. It has been in recession since 2022, below the 50 mark, except for 1 month where it popped up. And we're not expecting a change there either. ISM expected it at 47.5, up a little bit from 47.2. So there seems to be some sort of manufacturing recession going on that hasn't dragged the overall economy down yet.
No, it hasn't. And we know that the immigration story is the one that's been used to discuss the unemployment numbers. But when it comes to the data, Powell certainly in the camp of, look, if I see something more aggressive, we will move. And then you've got Larry Fink on the tape this morning talking about a no landing scenario versus a soft landing scenario. So in terms of the data, what do we need to see? Well,
Powell basically says we need to see what we predicted at the last meeting, which is 4.2% unemployment, 4.4% by the end of the year unemployment, and growth of a little more than 2%. And right now we're coming in well ahead of that. The Atlanta Fed GDP says 3.1%. But if we get that, here's what Jay Powell said about what the Fed's going to do.
This is not a committee that feels like it's in a hurry to cut rates quickly. It's a committee that wants to be guided. Ultimately, we will be guided by the incoming data. The bulk of the committee was at 75 or 100 basis points, and the votes were on 50, and that would mean 2 more cuts. It wouldn't mean more 50s. Now, of course, that'll depend on the data. But ultimately, that's what the baseline is. If the economy performs as expected, that would mean 2 more cuts this year.
In other words, to use another phrase, Danny, hold your horses, according to the Fed chairman. Although, interestingly, the Fed funds futures collapsed a little bit yesterday when he said that, but they're pretty much back to where they were, 1.4 cuts before he spoke. So the market is going to keep pushing, and the Fed will keep pushing back, and we'll see what the data say.
Yeah, perhaps Deutsche Bank were a little bit out of sync when they said it was a conditional pushback, but he didn't necessarily win the war. Mike, thank you very much. That's Mike McKee with the synopsis of what Jay Powell had to say to us yesterday. Kathryn Rooney was listening in. Kathryn Rooney Vera, Chief Market Strategist over at StoneX Financial. Good to have you with us. So, you know, the bond market was listening more to Powell than the equity market was listening. How much of a recalibration do you think he really achieved yesterday, Kathryn? Good morning.
Hi, good morning. Well, at least he pushed back on expectations that there would be pretty aggressive cuts. And I think that was becoming more of the consensus view that Powell was going to launch an additional 100 to 200 basis point in cuts in the next 12 months. And the truth is, if the economy continues to grow markedly above potential, that's not going to happen. That's my viewpoint. The Atlanta Nowcast published their expectation, or whatever their forecast is for the third quarter of this year, and that came at 3.1%. So that to me doesn't sound like a soft landing. It sounds more like a no landing. And if the U.S. economy continues to operate so much above potential, and we have additional industrial policy protectionism, I think that could as well be inflationary, causing a real problem for the Fed. And I didn't even mention the conflagration that we've seen in the Middle East and the robustness of the stimuli out of China, all of which, of course, is positive for commodities and thereby positive for inflationary pressures going into 2025.
Kathryn, that sounds like a good reason to be a little bit bearish risk, but you're not. You say the risk for the S&P 500 is to the upside. Why?
Well, I think the Fed is going to cut another 2 times, probably this year, 25 basis points each, not at the 50 pace that a lot of people are expecting, rightly so, because the Fed launched with a 50 basis point cut. But I do think that the momentum is to the upside. This is the best electoral outcome for the markets in the lead up to an election that we've seen in a really long time. I think that this election, if we get a division in Congress, the Senate and the House going to different powers, different hands, it really almost doesn't matter to the markets who takes the presidency, because it limits the more extreme policy making ideas. So I do think that the elections, unless we get which is a real possibility, unless we do not get a clear victor on the night of November 5th, the markets drop. In my opinion, Danny, that's a buy.
Okay, so you want to buy all dips if we go into perhaps a contested election. But the one thing that you did put there is a no landing on the table with tariffs equals inflation and some geopolitical risk. How fat a tail risk is inflation then for you going into 2025? Is that where you lean into when you buy the dip?
Under a no landing scenario, I think the risk of a reacceleration in inflation is very real. And that is why coming into this year, I've been recommending gold. Gold's done very well. I think that you want to be positioned in some amount in cash. I think utilities was my top pick this year. I think and it's done extraordinarily well. Going into next year, I think the pick is going to be healthcare. I'm saying protect your earnings, protect your gains, because while there is near-term momentum, there are inherent underpriced and, in my opinion, very large risks that need to be accounted for in portfolio positioning. And you can buy, a portfolio manager can buy pretty relatively cheap puts to protect those positions on the equity front. And I think, as one of your guests prior to me talked about, fixed income is looking really attractive. And I would even look at mortgage-backed securities in that light.
When it comes to healthcare, it has underperformed the S&P this year. To your point, 13% year gain, the S&P something like 21%. Why hasn't it rallied with the rest of the defensive sectors? Why hasn't it kept pace with something like utilities, which, as you say, you were spot on with that call?
Yeah, thank you. Utilities was a big call for us this year, and I think that is an AI play, whereas healthcare is not. So that was my call going into this year, and it seems to have played out now as consensus, which is, of course, that AI sucks quite a bit of energy. Also, industrial real estate. These are two things that I think, as one of your prior guests also mentioned, all boats rise with this AI revolution. But specifically, second order effects, I think, Danny, are in utilities and industrial real estate. Utilities is largely played out, so I'm looking for the next underpriced sector. And I like the fact that it's defensive. So I think that going into next year, it makes sense to me.
Kathryn, it is always a real pleasure speaking with you. Thanks for joining us so early this morning. Kathryn Rooney Vera of StoneX Financial. Coming up, VPs go head-to-head. We're going to preview the first debate and the last between J.D. Vance and Tim Walz. That's coming up next in your brief.
The United States will continue to work with our partners in the region and around the world to advance a diplomatic resolution that provides real security to Israel, to Lebanon, and allows citizens on both sides of the border to return to their homes. Diplomacy remains the best and only path to achieving greater stability in the Middle East.
Secretary of State there, Antony Blinken, speaking yesterday before the escalation in the Middle East overnight, where the Israeli troops began their ground raids into Lebanon. And this morning, the Israel Defense Forces say millions of Israelis are in shelter following projectile launches from Lebanon targeting central Israel. This is coming as the U.S. says it's deploying a few more thousand troops to the region to defend Israel. The Defense Secretary, Lloyd Austin, posting on X after speaking with Israeli counterparts, saying, "We agreed on the necessity of dismantling the attack infrastructure along the border to ensure the Lebanese Hezbollah cannot conduct October 7-style attacks on Israel's northern communities." David Gura is with us this morning. David, this is the beginning of a new escalation into Lebanon. The debate is whether this is a short, sharp incursion and withdrawal to build a bigger buffer. But when you see more troops being deployed, and Lloyd Austin talks about the importance of ultimately pivoting from a military operation to diplomacy, diplomacy looks very far away at the moment.
Yeah, so the word targeting, I think, is doing a lot of work here this morning as we look at what's happening, and Israel saying that these are targeted attacks in Lebanon. But you're right to mention that over these last many months, the United States has been emphatic that diplomacy is the only solution here, calling for a ceasefire. Even over this weekend, there was this shuttle diplomacy happening between the U.S. and Israel, kind of urging them not to launch these kinds of attacks, and lo, Israel did. So I think the U.S. is sort of waiting with bated breath here as you say, they're bringing more military might to bear in the Middle East. worried, I think, about contagion and fallout in the region. And at this point, it's still difficult to sort of see the magnitude of what's happening here. We've seen evidence of these attacks, and of course, there have been aerial bombardments of Beirut as well. The first time we've seen that in more than a year. So I think the U.S. watching here, obviously with some frustration over the fact that what influence they might have had in the past doesn't seem to be coming to bear here this time around.
If we can bring it back closer to home, we're going to have the first and only vice presidential debate. And maybe it has more importance because we just haven't had as many debates with the ticket as it currently stands. But what are the stakes for this?
So historically, when you have a debate of vice presidential candidates, the objective is to not do anything that will ruffle feathers or kind of make them stand out. I think that what makes this one unique is that, unlike in the past, where the VP debate has been kind of sandwiched between presidential debates, this is it for the vice presidential nominees. It's also it for the presidential nominees as well. There's very little hope that there's going to be another presidential debate before the election. So I think that it's a high-pressure moment for both of these candidates. A lot of Americans haven't seen them individually or together, haven't seen the debate on a national stage before. Both of them taking this very seriously, having done mock debates over these last couple of weeks. So I think a moment when they kind of step onto the national stage and we better get a better sense of just sort of how they would comport themselves on that.
I think it's going to be an interesting one. You just read the New York Times, they're talking about Vance preparing with what he calls a murder board prep sessions. In other words, rat-tat-tat, real rapid-fire questions versus Waltz. We'll see how that plays out, and we'll have full coverage of that. Both the campaigns responding to Hurricane Helene. You had Vice President, of course, at FEMA, and then you had Trump in Georgia. And again, politicizing to a certain extent what is a horrendous situation in some of these southern swing states.
And President Biden saying he's going to do an aerial flyover of Asheville, North Carolina on Wednesday of this week. I'm from North Carolina and have friends who live in the western part of the state. And as they describe it to me, the devastation is kind of unfathomable. And the complicating factor is a lot of the roads that would lead into a place like Asheville, Buncombe County in western North Carolina are simply washed out. So people are stuck with feet of water around them, very little infrastructure, no power, no communication. So you're right, Manus. I think that it's a very dire situation, and politics has to play delicately. We had former President Trump going to Georgia yesterday, attracting some criticism for going there at a moment when all of these emergency responders are trying to work and do as much as they can. Obviously, the visit of a former or current president complicates that. So when you look at what President Biden has proposed here, it is not to go on the ground yet, to do that in time to make it to Georgia and other states as well in the coming days, but to fly over at this point.
There's some just extremely delicate situations that the Biden administration has to deal with an eye on the election. I mean, the port strike that happened at midnight certainly feels like one of those. Is there any sense that the Biden administration will more forcefully step in and do something to try to resolve it for fear of those headlines heading into the holiday season that just don't look good?
Well, President Biden, as you know, has said that he won't do that, and he's somebody who's closely aligned himself with unions throughout his entire political career. He's saying he's going to do that as well. But you're right, this is a crucible or a moment when this isn't great for them, and they've had kind of difficulties with unions over these last many months. Vice President Harris as well. Obviously, she wanted the endorsement of the Teamsters. She didn't get them. But I think both candidates acutely aware of what effect this could have on the economy, and these projections of it having $3 to $4 billion worth of damage to the economy is just huge, and nothing that they want here 5 weeks before the election.
Right, and as Manus put it, I'll abbreviate the Teamsters president saying the U.S. government should stay the F out of the negotiations.
She's braver than I. I didn't actually go over the F, but Danny went full blown.
Say the word.
No,
say the word.
No.
David, thank you so much. That's Bloomberg's David Gurr. We really appreciate it. And tune in to special coverage tonight of the debate on Bloomberg TV starting at 8 p.m. Eastern. Okay. Let's turn now to this equity market, a stock we're keeping our eye on, CVS. Shares are climbing in the pre-market trade this morning, up 2.2%. It's said to be conducting a strategic review of options, including a possible breakup. All of that, according to Bloomberg sources. For more on this, let's bring in Bloomberg's Dasha Afanasieva. Dasha, just what is potentially CVS proposing here?
So CVS has 3 units. You've got your benefits arm, which includes that $70 billion acquisition of Aetna Insurance it did like 6 years ago. It's got a business that does provide services in clinics and in homes. These are healthcare services. And finally, it's got its pharmacy services and diagnostics and vaccines, as well as prescriptions, of course, and things like vitamins, etc. They're roughly pretty much evenly split in terms of revenue, but each one of those units is struggling to either grow sales or to grow operating profit, or both. There's increased scrutiny of drugs and healthcare prices, and costs have actually gone up since the pandemic because there's this backlog of treatments. The company cut its profit outlook for the year in May, and now is looking at these options reportedly.
Well, look, they've already taken some remedial action, haven't they, in terms of trying to fix some of the parts of the business. What's working or what's not working, as the case may be?
Yes, so they got rid of their head of the benefits unit, and Chief Executive Kathryn Lynch has actually stepped in to run that together with her CFO in the interim whilst they look for someone else. They've also got a multi-year plan to make productivity savings to the tune of $2 billion. But the thing is, just as recently as last year, they doubled down on this healthcare integration by making two decent-sized acquisitions. You had a chain of clinics treating elderly patients called Oak Tree that had bought for $11 billion, including debt, and also Signify Health, which was around $8 billion just last year. And it does seem like that broader healthcare integration narrative isn't really working. So it sort of makes sense that that bankers are pitching the alternative with sort of a breakup. Time will tell if the market will actually respond to that kind of breakup positively.
OK, well, we're up 2.1% at the moment on the stock, and healthcare and the logistics and regulation around that are going to be a hot topic in this election here in the United States. Dasha, thank you very much. Dasha Afanasieva on the very latest with CVS. Coming up on the show, economic data ahead for you on the slate, a vice presidential candidate debate for you on stage. Context matters. This is Bloomberg. It's Bloomberg Brief. I'm Menace Crenny in New York. Your day ahead looks a little bit like this. S&P PMIs hit the tape at 9:45 Eastern. ISM manufacturing and JOLTS come at 10 a.m. We're going to hear more Fed speak. We've got Bostic, Cook, Barkin and Collins all starting off at 11 a.m. And then we count down to Governor Tim Walz and Senator J.D. Vance. They square off in the vice presidential debate. That's at 9 p.m. this evening. You can watch it right here on Bloomberg Television. Some movers for you. This is what we got. Zim Integrated Shipping. The shippers lower as the U.S. ports shut for the strike. Disney falling. Raymond James downgrades the stock. They say that there is weakness in the parks business. And Atlassian gains after Raymond James upgrades the stock on cloud optimism. So we've got a nice bid there for Atlassian at the end. This is state of play on the equity markets. Look, you start the fourth quarter after having put on $2.5 trillion worth in the third quarter. The message from our guest this morning has been very, very clear. You want to be long of risk and long of bonds. That was the message from Emma Waller at Hargreaves Lansdown. It's very simple. Keep it simple. Buy bonds, buy duration. Yields fall ever so slightly this morning. We're counting down to JOLTS. There was a message from Jay Powell. This committee is not in a hurry. So there's some conditional pushback from the chair, but did he achieve much? No, because the market's still pushing for further rate cuts. Larry Fink says it's a no landing. Larry Fink says the forwards rates market is quite frankly crazy at 190 basis points of cuts by the end of next year. Yields dip. Danny's off to the port. We'll see you again tomorrow morning. We'll take you into day 2 of the port closures across the eastern seaboard and the Gulf. That's it for Bloomberg Brief. Surveillance is up next with Jonathan, Lisa and Anne-Marie from New York. Good morning.